Welcome to The Deep Dive, where we cut through the financial noise to uncover the real story. Today, we're plunging into Alcoa Corporation's second quarter 2025 earnings call. It's a really revealing period. Shows a company navigating some pretty significant short-term headwinds, especially those U.S. tariffs. But at the same time, they're reinforcing their long-term strategic position. We've meticulously gone through every statement, every number, all the forward-looking stuff to really distill what matters for you, helping you understand how Alcoa is handling this kind of dual challenge.
Exactly. Our mission today, it's really to go beyond just the reported figures. We want to give you the strategic context, the operational realities, and the broader market dynamics, because all that is shaping Alcoa's trajectory and honestly the whole aluminum industry too.
Okay, so let's kick things off with a snapshot of their Q2 2025 results. Alcoa reported revenue of $3 billion. That was actually down 10% sequentially.
Right.
Net income attributable to Alcoa came in at $164 million. That's a pretty notable drop from $548 million just the quarter before.
Yeah, quite a dip.
And that translated to earnings per common share of 62 cents or a little over 39 cents on an adjusted basis.
And if we dig a bit deeper into those numbers, adjusted EBITDA, that's, earnings before interest, taxes, depreciation, amortization, adjusted for the one-offs.
You see that clearer operational picture.
Exactly. It came in at $313 million. Now, that's a significant sequential decrease, $542 million down. But, and this is important, despite these headwinds, they kept positive cash flow from operations, $488 million. And free cash flow was $357 million. Plus, they ended the quarter with a solid cash position, $1.5 billion.
Yeah, so while those top-line numbers show the sequential decline, Alcoa's kind of underlying financial resilience, especially how they manage capital, it does offer some positive signals.
It does.
Their year-to-date return on equity was positive, 22.5%. And days working capital stayed flat sequentially, pretty lean at 47 days. Plus, they returned $27 million to stockholders through the dividend. That signals some robust internal discipline, critical for investors looking beyond just the top line.
And, beyond the quarterly numbers, two really significant strategic things happen. First, they closed the sale of their stake in the Modin joint ventures. That was July 1st. Valued at $1.35 billion, mostly shares, bit of cash.
Right, Modin sale.
Second, a major win for them was finishing that 5-year tax dispute in Australia. Affirmed no extra tax was owed. And this isn't just like a legal win. It removes a huge multi-year overhang. Lets management focus on growth, not past liabilities.
Okay, so those numbers definitely show a big dip. That nearly $500 million sequential drop in EBITDA is quite something. What's really driving that? Let's peel back the layers here.
Well, the primary culprits were lower alumina and aluminum prices. That's number one. But critically, increased U.S. Section 232 tariff costs, the ones on aluminum imported from their Canadian smelters. That also played a really substantial role.
Okay.
So to break it down, the alumina segment's adjusted EBITDA, down $525 million, mostly lower prices, but also higher production, energy, and raw material costs piled on.
And drilling down into the tariff situation specifically, sounds like that had a major impact too.
Oh, absolutely. The aluminum segment's adjusted EBITDA decreased by $37 million, but get this, $95 million of that was U.S. Section 232 tariffs alone.
$95 million, wow.
Yeah, and for listeners, these are those specific import duties the U.S. put on certain goods, aluminum in this case. The rate just jumped, right? From 25% to 50% effective June 4th. That really hit Alcoa's Canadian imports hard.
Okay, so put that $95 million into perspective for us. How did it actually play out with pricing?
Right. So in Q2, Alcoa paid about $115 million in total tariff costs. Meanwhile, the Midwest premium, that's the regional surcharge on top of the LME price for delivery in the U.S. Midwest,
right,
it only gave them about $60 million in uplift on those Canadian tons. So you do the math, that's about $55 million in margin compression just on the specific volumes. It highlights a very real challenge they're facing.
Indeed. Okay, so how are they responding? I mean, they can't just be sitting there taking that hit, right?
No, they've shown actually remarkable agility. Since March, they've redirected over 100,000 metric tons of Canadian metal, the stuff that usually goes to the U.S.
Where'd it go?
To non-U.S. customers. They actually have the flexibility to redirect about 30% of their Canadian volume based on netbacks, which basically means they pivot to whichever market offers the highest net price after all costs, like tariffs and shipping. That flexibility is absolutely key right now.
Okay, that makes sense for managing the immediate hit. But what about the longer term? Are they doing anything on the policy front?
Yeah, management mentioned active advocacy, both sides of the U.S.-Canada border. Their argument is pretty compelling. The U.S. market needs aluminum. It has a deficit. Building new domestic capacity, it's incredibly time-consuming, incredibly expensive. We're talking 5+ years, maybe $30 billion, 6 gigawatts of power needed for 4 million tons.
Huge numbers.
Huge. Plus, the supply chain is tightly integrated with Canada. They pointed out it supports like 12 to 13 U.S. downstream jobs for every one Canadian primary upstream job. Now, the Midwest premium, it does pass on about 90% of the tariff cost to customers, mostly, but it still doesn't fully cover the total tariff cost for Alcoa.
Right, that $55 million gap we talked about.
Exactly. They figure the premium needs to be somewhere between $0.75 and $0.75 per pound to fully offset it. Right now, it's around $0.67, still short.
Okay. So beyond the tariffs, which are clearly a massive issue, Alcoa is also juggling some operational hurdles, right?
They are. The restart of the San Ciprian smelter in Spain, for instance, that got disrupted by a power outage back in April. It's pushed the full ramp up into mid-2026 now.
Okay.
Now, the smelter itself is expected to be profitable once it's fully ramped, but the refinery there, that'll likely stay in a loss position through 2026.
Got it. And wasn't there something in Brazil, too?
Yeah, ongoing struggles at the Alumar smelter. It's running at about 92% capacity. They've had some unexpected pot failures there. But on a more positive note, as we mentioned earlier, that Australian tax dispute.
The win? Yeah.
Right. That required a $225 million tax payable by mid-next year. It's now fully reserved on the balance sheet. It's considered a significant victory, removes that financial cloud.
Okay. So looking at their full year outlook now, they adjusted aluminum shipments down, right?
Sure.
To 2.5 to 2.6 million metric tons.
Primarily because of those San Ciprian delays, yeah. They did lower corporate costs, which helps, but interest expense actually increased because of some unfavorable VAT assessments.
And for Q3 specifically, what are they forecasting?
Well, they expect higher Midwest premium revenue, which is good news, but they also anticipate about $90 million in sequential expense increases just for tariff costs.
Another 90 million?
Yeah. They're projecting quarterly tariff costs could be around $215 million based on current LME and Midwest premium levels. It's a really complex dynamic they're managing quarter to quarter.
Okay, lastly on the financials, capital allocation. Where do they stand with debt?
Their adjusted net debt improved. It's down to $1.7 billion. That puts them just $200 million away from the high end of their target range, which is $1.5 billion.
Getting close.
Getting close. So it's clear they're prioritizing deleveraging first, get that adjusted debt, including pension, closer to their ultimate $2.1 billion target. But once they hit that range, they've signaled they'll also consider shareholder returns, portfolio actions, maybe some growth opportunities.
Right, makes sense.
So, okay, if we zoom out now and try to connect all of this to the bigger picture, despite all this near-term tariff volatility and the operational stuff, the long-term outlook for aluminum demand, it still looks remarkably robust.
Yeah.
Yeah, it's underpinned by these powerful global mega trends that just aren't going away.
And the data seems to back that up. Transportation is leading the charge, right? Largest and fastest growing sector. Fueled by the EV shift, lightweighting for efficiency.
Absolutely. Packaging is expanding rapidly too. Consumers want recyclable materials, and electrical demand is really accelerating with the whole global energy transition. It's fundamental.
Right.
And what's particularly insightful, I think, is the shifting geography of growth. Primary aluminum demand outside China projected to grow significantly faster, like a 3% compound annual growth rate from 2025 to 2030. Yeah. Compare that to China's 0.2% growth, which is mostly met by recycled metal anyway.
And North America is leading that outside China growth.
Expected to, yeah.
Yeah.
With an impressive 3.8% CAGR. That's a strong regional story playing out.
And you mentioned structural drivers underpinning this demand.
3 main ones. First, the green and digital transition. Aluminum is just essential for electrification, decarbonization.
Can't do without it.
Pretty much. Second, the rise of developing economies, plus those reshoring trends we're seeing in North America and Europe. And third, material substitution. Aluminum's recyclability makes it a preferred alternative in so many applications, especially as sustainability becomes, core for industry.
Okay, so strong long-term demand picture. What about the specific markets right now? Alumina, bauxite.
Yeah, so alumina prices actually rebounded in Q2 after a sharp drop earlier. That was largely because about 10 million metric tons of Chinese refining capacity got curtailed or reduced, brought the market into better balance.
Okay.
Bauxite prices, though, they're still elevated, mainly due to supply uncertainty, particularly coming out of Guinea.
Got it. And the aluminum market itself LME prices?
LME recovered from a dip in April, but they're still below Q1 levels overall. The U.S. Midwest premium, as we discussed, surged after those 50% tariffs hit, reached $1.67 per pound, but again, still below the level needed to fully offset the tariff costs for importers like Alcoa.
And demand conditions generally, Europe, North America?
Pretty steady, actually. Electrical and packaging sectors are doing well. Construction seems to be stabilizing. Automotive is still feeling the impact of that tariff uncertainty, though. And globally, production remains constrained, especially outside China, which just reinforces that long-term demand thesis.
Okay, one last thing on the long-term horizon. The Western Australia mine approvals. That sounds significant.
It is. There's a delay in approvals for Alcoa's next big mine regions there, Myara North and Holyoke. The original timeline, they were hoping for ministerial approval in Q1 2026. That's no longer looking feasible.
Pushed out.
Expectations are now extending beyond that time frame. However, Alcoa says they do have contingency plans. They reckon they can cover up to a 15-month delay by accessing bauxite from existing areas. So, yeah, it's a bump in the road, but seems they have a plan B ready.
Right. Okay. A lot to digest there.
Definitely.
So let's shift gears a bit. Time for our This Is Not Financial Advice segment. Given everything we've just covered, the tariff mess, the operational bits, the strong demand, the deleveraging, if you had to pitch an outrageous but plausible trade idea, what comes to mind?
Okay, outrageous but plausible. Here's one, focusing on the short term. Let's call it the tariff arbitrage play. So given Alcoa's strategy, right, redirecting 30% of Canadian volume away from the U.S. when netbacks are better elsewhere, and given the Midwest premium still isn't fully covering tariff costs.
Still got that gap.
Still got that gap. Consider a short-term long position on Midwest premium futures. The thesis, Alcoa's redirection, and probably others doing similar things, will further tighten U.S. supply. That should, theoretically, force the Midwest premium higher, closer to that $75 per pound needed to really offset the tariffs. It's not just pure speculation. It's a bet on market mechanics forcing an equilibrium because of the existing trade policy, the outrageous part. You're banking on these policy-driven market inefficiencies to resolve themselves through market action rather than waiting for the policy itself to change.
Interesting. Betting on market forces over policy change. Okay, that's definitely thinking outside the box. What about something a bit longer term, a more strategic play?
Okay, for a more medium-term idea, maybe consider a long position on Alcoa itself, but tied to two specific things: their capital allocation discipline and resolving those mine approvals. The company is actively delevering, right? They're aiming for that net debt target only $200 million away now.
Right.
Success there, combined with eventual clarity and approval on the Western Australia mine plans, even if it's delayed to, say, 2028, that would remove significant uncertainty that's arguably weighing on the stock right now. The outrageous element here, you're betting on bureaucratic processes eventually yielding a result.
Always a gamble.
Always a gamble. And you're betting on the management team's disciplined capital return framework overriding all this current short-term operational noise. It's really a patient play, betting on the underlying value being unlocked eventually.
Got it. Two very different thought-provoking ideas there. Okay, so we've covered a tremendous amount in this deep dive, from Alcoa's strategic moves like the asset sales and that big legal win in Australia, to the really significant financial impact of these tariffs and how they're trying to proactively mitigate them.
Yeah, and we also explored the ongoing operational challenges, in Spain and Brazil, and contrasted that with the really crucial long-term demand drivers for aluminum, plus the latest on their Western Australia mine development.
It's clear Alcoa is navigating a very complex landscape, balancing this near-term market volatility against what look like pretty robust long-term demand fundamentals.
Absolutely. Their focus seems squarely on operational execution, strategic portfolio management, and just adapting dynamically to these shifting global trade dynamics.
So just a reminder to everyone listening, the information shared here, it's for educational purposes only. It should definitely not be considered financial advice. Always do your own research and consult with a financial professional before making any investment decisions.
Yeah, and we really encourage you to reflect on how these insights apply to your own understanding, your own view of the aluminum market, and Alcoa's position within it. What stands out to you from today's discussion about, navigating these headwinds, but also trying to seize those long-term opportunities?
Good question to ponder. Thank you for joining us on the Deep Dive. We'll be back soon with another deep dive into the numbers that matter.